I want to start with something that Bank of America sent to its wealthiest clients this week. Not to retail investors, not to you, not to me, but to the hedge funds and institutional money managers who pay $50,000 a year for access to their private research notes. This is the kind of institutional intelligence that separates the smart money from the everyday retail trader who is currently panicking about the headlines. In this exclusive memo, they detailed a scenario that most people are completely unprepared for: a violent repricing of global assets triggered by a full-scale U.S.-Iran war. But more importantly, they outlined exactly how this geopolitical earthquake will create a generational wealth opportunity for those who understand the hidden mechanism of market crashes. Ray Dalio has been issuing a severe warning about this exact geopolitical setup, pointing out that we are at the precipice of a changing world order where great power conflicts inevitably disrupt global supply chains, spike inflation, and force a massive structural shift in how capital is allocated. The retail crowd is paralyzed by fear, selling their beaten-down equities at the exact wrong moment, while the institutional giants are quietly preparing to deploy billions of dollars into specific sectors that will skyrocket when the inevitable policy panic occurs. If you want to understand how to position yourself alongside the most powerful investors in the world, and turn this impending everything crash into the most profitable period of your financial life, you need to pay very close attention to what I am about to break down. Subscribe now. Let me explain why this is happening and how the underlying architecture of the global economy guarantees a specific chain of events that you can front-run. Imagine we are looking at the financial landscape in March 2026, a hyper-realistic scenario where the conflict in the Middle East has escalated beyond proxy skirmishes and direct military engagement between the United States and Iran has effectively closed the Strait of Hormuz, choking off 20% of the world's daily oil supply. We are talking about a scenario where Brent crude surges past $150 a barrel, WTI crude breaks through $140, and the global flow of liquefied natural gas is severely constrained, sending energy markets into an absolute freefall of panic and uncertainty. The S&P 500 has plummeted by 25% in a matter of weeks. The VIX is trading consistently above 40, and the RSI on major indices is showing historically oversold levels that we have not witnessed since the depths of the 2008 financial crisis. This is the reality of the everything crash, a moment of maximum pessimism where every single asset class seems to be moving lower in tandem, driven by the fear that permanently higher energy costs will crush corporate profit margins and tip the global economy into a deep, protracted recession. But here is the mechanism that the mainstream media completely ignores, and that Bank of America's $50,000 research note explicitly highlights for its elite clients. The initial shock of the war causes oil to spike, which acts as a massive regressive tax on the global consumer, instantly destroying demand and accelerating the timeline for a severe economic contraction. This deflationary shock, disguised temporarily as an inflationary energy spike, forces the central banks into a corner where they can no longer maintain restrictive monetary policies without risking a complete collapse of the sovereign bond market and the broader financial system. This leads us to the hidden mechanism of the policy panic, a predictable sequence of events where the Federal Reserve is forced to aggressively pivot from fighting inflation to desperately trying to save the economy from a deflationary depression. They will slash interest rates to zero, restart massive quantitative easing or QE programs, and flood the system with liquidity while the government simultaneously coordinates massive SPR releases to artificially suppress the price of oil and stabilize the energy markets. There are three specific triggers that will cause this inevitable Fed pivot, and watching for these triggers is how you unlock the timing for your investments. First, you will see a sudden and severe spike in unemployment claims as corporations, terrified by the collapsing consumer demand and soaring input costs, aggressively remove leverage and slash their workforces to protect their balance sheets. Second, you will witness a dislocation in the credit markets, specifically a blowout in high-yield corporate bond spreads, indicating that the debt markets are freezing up and companies can no longer roll over their short-term liabilities. Third, there will be a coordinated chorus of Wall Street megabanks led by Morgan Stanley and Goldman Sachs, publicly demanding intervention to prevent a systemic failure, which provides the political cover the Fed needs to capitulate and reverse course. When these three triggers align, the policy panic is officially underway, and the window to position yourself for maximum upside begins to rapidly close. Now, let me tell you exactly where the smart money is moving and provide you with the sector-by-sector investment playbook that will turn this crisis into your personal fortune. The first sector is energy infrastructure, specifically companies that control the domestic pipelines, storage facilities, and export terminals for liquefied natural gas. Because as the Middle East becomes uninvestable and unreliable, the United States will be forced to permanently double down on its own energy independence, making these hard assets incredibly valuable and immune to the geopolitical chaos overseas. The second sector is defense, but not just the legacy aerospace contractors building fighter jets. You need to focus on the next generation defense technology companies that specialize in cyber warfare, autonomous drone systems, and space-based surveillance, because the U.S.-Iran conflict will heavily feature asymmetric warfare and the Pentagon will unleash a massive wave of spending to modernize its capabilities. The third sector is consumer discretionary, which sounds completely counterintuitive during an economic crash, but this is exactly where the greatest asymmetrical returns are hidden. Historically, when the market bottoms and the Fed injects trillions of dollars of liquidity into the system, the most beaten down consumer stocks experience a violent upward revaluation because the market is a forward-looking mechanism that begins pricing in the economic recovery long before the actual data improves. In fact, historical data shows an 82% hit rate of massive market recoveries being led by consumer discretionary stocks in the 12 months following a major geopolitical or economic shock, as retail investors who panic sold at the bottom are forced to chase the rally higher. The fourth sector is the intersection of software and finance, specifically the companies driving the AI CapEx cycle, because artificial intelligence is the ultimate deflationary tool that corporations will use to rebuild their margins in a high-cost environment. As companies remove leverage and cut human headcount, they will aggressively reinvest that capital into software automation, making the dominant AI and financial technology platforms the undisputed winners of the post-crash economy. But knowing what to buy is only half the equation. You must also understand how to evaluate the damage and manage your risk during the chaos. Let me break down the framework for separating structural damage from temporary damage, which is the most critical skill for crisis investing. Structural damage occurs when a company's core business model is permanently impaired by the changing world order, such as a business that relies entirely on cheap, uninterrupted global supply chains that no longer exist, or a company carrying massive amounts of floating rate debt that will bankrupt them before the Fed can pivot. Temporary damage, on the other hand, is when a fundamentally phenomenal business sees its stock price cut in half simply because of forced liquidation by hedge funds facing margin calls, or because retail investors are blindly selling index funds in a panic. Your job is to identify the companies suffering only temporary damage, the ones with fortress balance sheets, pricing power, and indispensable products, and buy them aggressively when the fear is at its absolute maximum. To execute this properly, you must follow 3 golden rules of crisis investing that the institutional elite never deviate from. Rule number 1 is that you must never try to catch a falling knife without a macro catalyst. You do not buy simply because a stock is down 30%. You buy because you have identified the specific policy panic or liquidity injection that will reverse the trend. Rule number 2 is that you must ruthlessly separate your political or emotional opinions about the war from your objective financial analysis. The market does not care about your feelings regarding the US-Iran conflict. It only cares about the flow of capital, the price of oil, and the trajectory of corporate earnings. Rule number 3 is that you must maintain enough cash reserves to survive the initial violent repricing without being forced to liquidate your core holdings at the bottom, ensuring that you have the dry powder ready to deploy when the institutional signals flash green. History is fiercely repetitive, and if you look back at the major geopolitical and economic shocks of the last 50 years, you will see this exact same pattern play out time and time again. Look at the 1973 oil embargo, where the initial shock crashed the markets, but the subsequent policy responses created massive opportunities in domestic energy and hard assets. Look at the 1979 Iranian Revolution, which caused another massive spike in crude oil and a severe market downturn. Yet those who bought the panic and positioned for the eventual stabilization made absolute fortunes in the ensuing bull market. Look at the 1991 Gulf War, where the market actually bottomed and began a massive multi-year rally almost exactly on the day the ground invasion began, because the uncertainty was finally removed and the institutional money knew that the worst-case scenarios were already fully priced into the equities. Look at the 2008 financial crisis, which was not a war, but featured the exact same mechanism of a terrifying deflationary crash, followed by an unprecedented policy panic and a flood of QE that birthed the longest bull market in history. In every single one of these instances, the retail public was paralyzed by pessimism, convinced that the world was ending, while the wealthiest investors utilized their exclusive institutional intelligence to buy high-quality assets at generational discounts. The warnings from billionaires like Ray Dalio are not meant to scare you into hiding your money under a mattress. They are meant to wake you up to the reality that the global macro environment is shifting rapidly and that massive wealth transfers always occur during periods of extreme volatility. The US-Iran war, should it fully materialize as the data suggests, will be a tragedy on a human level, but from a purely financial perspective, it is a catalyst that will violently shake weak hands out of the market and transfer their wealth to those who have the courage and the framework to act. You cannot wait for the mainstream financial news to give you the all-clear signal, because by the time the television pundits are telling you it is safe to buy stocks again, the smart money has already made their triple-digit returns and is looking to sell their positions to the latecomers. You have to be positioned before the obvious confirmation, relying on the leading indicators like the blowout in credit spreads, the spike in the VIX, and the extreme oversold readings on the RSI. You must understand that when the government announces emergency SPR releases and the Federal Reserve holds an unscheduled meeting to discuss emergency liquidity measures, that is your definitive signal that the bottom is either already in or is mere days away. The institutions paying $50,000 a year for Bank of America's private research are not waiting for certainty. They are calculating probabilities, managing their downside risk, and aggressively accumulating the exact sectors I have just outlined. They know that the energy infrastructure companies will generate massive free cash flow as domestic production ramps up to replace lost Middle Eastern barrels. They know that the defense sector will see a decade of guaranteed revenue growth as the changing world order forces every Western nation to dramatically increase their military budgets. They know that consumer discretionary stocks, despite the terrifying near-term economic data, will explode higher as the massive liquidity injections work their way through the financial system and eventually revive consumer spending. And they know that the AI CapEx cycle is an unstoppable structural force that will continue to attract hundreds of billions of dollars in investment, regardless of what is happening in the Strait of Hormuz, making the dominant software and finance tech monopolies the safest growth assets on the planet. This is the blueprint for surviving and thriving in the everything crash. You now possess the exact same analytical framework that the hedge funds use to navigate global crises. You understand the mechanism of the initial deflationary shock, the triggers that force the inevitable policy panic, the specific sectors that will benefit the most, and the rules for separating permanent structural destruction from temporary opportunity-creating damage. The only thing left is for you to execute when the time comes. Do not let the fear of a violent repricing paralyze you. Instead, use this knowledge to empower yourself, to look past the terrifying headlines, and to see the underlying mechanics of the global financial system at work. Watch the bond yields, watch the dollar, watch the high-yield credit spreads and the actions of the Federal Reserve, and use that watch time to perfectly position your portfolio for the wealth transfer of a lifetime.